Good morning, everybody. Hopefully you had a wonderful weekend and ready for the short week with the holiday approaching. So just a heads up, obviously there'll be no Friday call this week, but there will be a Monday call next week. So we're lucky today to have what I consider one of the best life insurance marketing idea people that I know. I've known him for 15 years, and he's going to share an idea with you that I think is a great idea. So it's Shane from ECA. Thanks, Shane, for being on today.
Yeah, thank you. So, hi everybody. Good morning. Hopefully your weekend was fun and relaxing. And just want to share a couple different sales ideas with you that I've been kind of promoting to the agents that I work with, and I thought I would share it out to all the 5Q guys and gals out there. So, the first one is the product Lincoln Money Guard. And surprisingly enough, a few months back, Lincoln National came here to visit us. And it surprised us that they said that roughly about 30 to 40% of all new sales are coming from clients ages 40 to 55. And we've never thought of the Money Guard product as being a younger age product, and we asked them how is this being sold? So they said it's really being sold by the investment advisors or advisors that do a lot of assets under management, and a little bit by annuity guys as well. But what they're stating is that the investment guys are looking at this product as a way to preserve a client's assets while they're in retirement. So we all know that you guys all do a good job of building up a client's asset bucket, whether it's in brokerage accounts, annuities, helping them with their 401k plans, etc., everything the clients are doing to save for retirement. But the biggest, obviously monkey on everybody's back once they hit retirement is the chronic illness or long-term care events that could actually deplete that asset pool once they hit retirement. So the investment advisors are really looking at the Money Guard product as a way to preserve that retirement pool once those clients get to that point. And what they're looking at is the 10-pay scenario for Money Guard, which is really the best way to leverage it. So they're typically carving off a portion of either A, investment money that's coming in to allocate towards the Money Guard product, or B, taking a little bit of the gain each year or distribution off the brokerage account to actually pay the premiums for the Money Guard. So on the 10-pay scenario, the Money Guard product has really came out to be, quite a good bucket of leveraging for these investment clients, because really what they want to do is take a 10-pay scenario. We're putting money in each year for 10 years. We use the 80% return of premium feature, so we don't use the 100% because the 80% will actually give them quite a bit more leveraging. And that way, we're really telling the client that we're using pennies on the dollars to not deplete their assets once they do start getting into retirement in case, again, the chronic illness event occurs. So one of the samples that I wanted to show everybody here is I'm going to pull it up on my screen. You should be able to see it. It's an actual illustration. Now, I did run this on a 45 male, and it works just as well on a female as well, so I do have examples that I can send out to everybody, but let me scroll down here. So in this scenario, you can see that we're using roughly a 10-pay of almost $5,000 per year, so roughly $400 a month. Now they put that into it, and we're going to use a 5% compounding feature, because obviously with inflation, we know long-term care costs are going up quite a bit. We use a 7-year duration. Let me show you the numbers, because actually this is where it kind of gets into the fun part of it. So as we know, the time of first need for a typical long-term care event is right around age 80, 77 to 83 is kind of the time of first need. So if I scroll out, you can kind of see here the plan premium for 10 years. At the end of the 10 years, surrender value is roughly just shy of $40,000. So how you position that to a client is that, as you're saying, that $40,000 technically is still in their asset pool. So they can always get that money back if they wish to walk away after the 10 years. So really, what is the out-of-pocket cost to the client? The out-of-pocket cost is about $10,000. And $10,000, it's real money, but in reality, it's not a lot of money when we compare it to what they get at that time of first need. So when I scroll down here to roughly age 80, you can see that we turn basically that $10,000 of leveraging into about a $1 million pool that's available for long-term care event. And if you scroll over even further, we see that in order to get that same $1 million pool, they'd have to get a 9.1% after-tax rate of return on those dollars in a side account. So as investment people, obviously you cannot guarantee anything in life on the investment side, let alone how hard is it to get a 9.1% guaranteed rate of return on somebody's dollars over a 36-year period. Pretty tough. And why is it good to show this product to clients? Well, one is that that's $1 million of actual money that they can use for chronic illness. If they didn't have that pool built up, they'd be pulling those monies out of their investment accounts, their 401k plans, their annuities, et cetera, to pay those long-term care costs. So that's quite a bit of a depletion for somebody, in the family unit of their overall retirement nest egg. So as an investment people or even annuity advisors, you can actually show a client by leveraging a little bit on the front end, roughly $10,000 of actual money you're going to potentially get a $1 million bucket for them later on in life, which is going to not severely hamper the overall retirement income stream for the surviving spouse who's not in the nursing home, as an example. So that's a pretty good way to position that product. What's in it for the advisors? Well, here's a couple different ideas on your guys' end. One is that how do you get paid on assets under management? Typically, it's a money management fee or some kind of other fee that you charge on the overall asset pool. If you have clients that get out to a certain point and need to deplete their retirement buckets, guess what? You get paid less commissions. So there you're preserving your overall AUM is one thought. Second thought is if you are deciding to get out of the business, so you're retiring at some point and you want to sell your book of business to somebody else, I would think it'd be a value add to tell them that you have a lot of your clients protected with this type of product, so it's not going to deplete their overall assets under management that you're transferring over to that new advisor who's buying your block out. So it does help you on that end as well. So literally, how it's being positioned is more of an asset preservation for pennies on the dollars, and just a great way to preserve the AUM, on your guys' end, and let the clients live a better lifestyle in retirement, so they don't have to worry about running out of money. That's the first sales idea I have. The second one is a little more in depth. It's actually a product that's been around for about a year or so. It's from American General. They call it the Asset Protector. And the product's really positioned in, again, the investment light as an asset allocation tool or an extra income bucket. And what do I mean by that? They have three specific features of the product that I want to speak about. Obviously, it is life insurance. So the main feature is if you die too soon, you have a income bucket that's there for the surviving spouse or family unit to provide that gap in that person, not living long enough to continue to accumulate for retirement. So it provides a immediate income bucket for the surviving spouse and kids upon death. Second of all, once they hit retirement, a couple of the biggest concerns that people have is, one is healthcare costs. Well, that's hard to control. Two is the long-term care costs, which will affect about 70% of all people that do retire. Long-term care is, a thing that everybody thinks about. And then the third is what happens if I live too long and my money starts to run out. This product is actually developed to kind of cover those three different concerns. Die too soon, get sick along the way, or live too long. So in a nutshell, how it works is that, obviously, you can look at your clients that are 45 to 60s where the product really sells or really sings. And typically those clients, one of the concerns is that if I happen to die, I have an income pool here that will provide for my family. Now, once I hit retirement, I have all these other assets, the 401k plans, your annuities, your assets under management, brokerage accounts, et cetera, that I can draw off of and spend as a retirement income stream. And what happens if I get sick? Where am I going to come up with the dollars? Well, one was the MoneyGuard product, obviously, if you have that on back shelf. Two, if they want to look at this type of product, it does have a chronic illness feature on it in most states, which allows you to accelerate the death benefit at a 2%, 4%, or a IRS per diem amount.
Hey, Shane, can I get in there a second?
Yeah.
Can I get in here a second? So, guys, just so you know, Shane's talking about a different product than is being displayed right now. So I don't want everybody to get confused. Yep. So he's actually just giving you an overview of the next product he's going to show. Thanks.
Yep. And that's the American General, again, Asset Protector,
okay.
Universal Life product. Yep.
Okay, good.
So, yep. So basically the chronic illness rider allows you to accelerate the death benefit, tax qualified, to help pay any kind of chronic illness events, nursing home stay, assisted living, home care, adult daycare, et cetera. So what that does is it provides another pool of dollars that you don't have to take out of your other accounts, potentially at a higher tax bracket, and actually drain those for the family unit again to lower their lifestyle. Now, another big concern is what happens if I live too long. Maybe the market didn't perform. Maybe I took too much money out and spent it too, foolishly and wasn't thinking. The product actually provides, which this is the big one that I think a lot of agents that I talk to really like, is this product actually allows you to be the beneficiary of your own policy. So what I mean by that is that at age 85, you can actually accelerate the death benefit as an income stream. So that's really the big kicker on this product, is that if you do happen to live too long and you say, hey, I need an extra, source of income, I can turn on that bucket, and basically over a 10-year period, you can actually accelerate your death benefit, pretty much tax-free, and then a little bit taxable on the backside, and I'll go over how that works. But you can turn that on as an extra income stream. Now, you don't have to turn it on if you don't wish to, but typically you're going to want to start drawing the money anyways because the product goes away at age 100, so you want to draw it out before 100, the death benefit, to get it out of there. So the example I'm going to bring up again is a male 45. Hopefully you can all see this on my screen.
Yep, you sure can.
And can you see it? Okay, good. Okay. So I'm going to go down. I'm just going to go down to the numbers page. You can see here that the premium, if we didn't do the chronic illness or the lifestyle income solution rider, which is basically your income rider on the backside, the cost for a $500,000 male 45 preferred would be roughly $4,400 a year. Okay, so $370 a month, which is not a huge premium, but it's, for clients that are saving money in brokerage accounts, $370 is probably not outside the realm of possibility. So this would buy them a $500,000 death benefit. So if they just did a product, say I just want life insurance and they want permanent, and nobody ever talked to them about the special features or riders, yeah, they're looking at $4,400. So if you look at the next two numbers here, 219 and 545, this 545 really, in a sense, is like adding on a long-term care policy, okay? That actually gives you access to the overall $500,000 pool of tax-qualified dollars. To me, that's a pretty cheap LTC benefit if you look out in the marketplace for standalone. Second of all, the extra $219 a year allows you to accelerate this $500 as an extra income stream. So what I look at that is, if I took $219 a year and put that into a side account, could I come up with a $500,000 guaranteed benefit pool of money for income in the future? That'd be pretty tough. So for these additional extra costs, it really adds on basically quite a few benefits that I think are very good for this age. Let me go down here real quick to the numbers. And I'm not going to go over the rider too in depth. Basically, it's kind of your typical 2 of 6 ADLs, or activities of daily living, to trigger the chronic illness rider is kind of the main thing. And I'll send you this information so you can go more in depth on it, or certainly you can ask your marketer here at ECA. So here's the ledger. As we can see, you put the money in, you go down, and by the way, this product actually has a return of premium feature in 20 years. So if the client said, you know what, I want out of it altogether, I just don't need it anymore, they could actually walk away and get half their money back. So that's a nice feature as well. Let's go down to age 85. And I'm going to go to the next piece here. Well, first of all, let me go back up. So at age 85, you can see you got to pay premiums to 85. If you look over here, internal rate of return on death benefit, what that is that if I took this same dollar amount, this $4,400 a year for 40 years, put that into an investment account or annuity or somewhere else, I'd have to earn a 4.51% guaranteed after-tax rate of return on those dollars, which is pretty tough to do as far as guaranteeing that rate of return. So what that can tell you is that as far as using this compared to, say, maybe an investment, it's actually a pretty good rate of return on those dollars to provide a $500,000 of income at some point down the line. Bear with me here. So here's an example of the actual income stream. Age 86, so that you paid 85, and then you can crank it on. So let's say, hey, I need some extra money. I spent maybe too much of it in retirement, and I want an extra income pool. You can see that you can start taking the money out over a 10-year period of $49,800. There's a $200 charge that comes out of there, but it actually adds in the backside. So in reality, you're going to get your whole $500,000 back out of the policy. So you paid $178. You got about a 4.51 after-tax rate return on those dollars. You had basically a chronic illness or pseudo long-term care policy built into it during your retirement years. If you died early, it gave you a $500,000 bucket for the family unit. And if you live too long and need the additional income, you can actually start drawing out of here the whole $500,000. How that works is that the first few years of income is actually a return of your premium, okay? So once you hit that 178, all of that is tax-free that comes out in the first few years. Once you hit your basis or your premium paid, anything else that comes out in these later years would be taxable as ordinary income, which is the same as any other investment or annuities as well. So it's no different than everything else that they have. But what's nice about it is you don't have to pull this money out. So if clients, start pulling money out of their other products, they hit the RMDs at age 70 and a half, they start pulling those monies out, you have an extra income bucket on the backside that you can actually, draw from during those later on retirement years. Couple ways to position the product, in my opinion, is one is I think you really position as an asset class when you're doing income planning for the client, due to that, yes, it is life insurance, but this $500,000 in reality is an asset starting day one. So you pay that first premium, you can put it on the books. You have $500,000 of cash there, whether it's for chronic illness, whether it's for death, or whether it's for later on income planning. So technically it is an asset. It's built in there. It's non-correlated to the market, so if the market drops 30%, this $500,000 doesn't drop 30%. So it's protected from market crashes, okay? So you have basically a non-correlated asset in reality. Second, it's basically used as a guaranteed hedge. So again, going back to the asset allocation model, you don't have to worry about the market fluctuations. You can use it in income laddering strategies, and I think Jeff's might be talking about that later.
Well, I'm going to jump in there, okay? I'm going to jump in there,
yeah,
Shane.
Go ahead.
So we've had a couple of questions here. So guys, what Shane is saying is this $500,000 is an immediate asset. Because either number one, you're going to get it as a death benefit, or if you don't use it as a death benefit, you're going to get long-term care payments from it. Or if you don't use it for either one of those things at age 85 or age 86, that $500,000, do you see how that $500,000 is going to be paid back to you as an income stream over the next 11 years? So any way you want to look at it, that as soon as you put that $4,462 in that first year, you've got $500,000 of assets there, whether it be for death benefit, long-term care, or you're going to be able to pull it out at age 80. Either your spouse is going to get it, the $500,000 tax-free, or you're going to get it at age 86 as an income stream. So does that make sense to you guys?
Correct.
So again, can you use this inside an IRA, 401k?
No. This is life insurance, so it's not an investment technically. It's life insurance. It can't be inside a qualified account.
There you go. So I think we answered all those questions. So does anybody have any questions? This is an asset immediately. What are the issue ages?
Issue age is up to age 70 because it has to be enforced. Couple caveats. It can't be a MEC because you can't put a single pay into it. It has to be stretched out, probably more or less like a 7 to 10 pay at the earliest. It has to be paid up by age 85. Okay, you can pay it off earlier. So if you're 45, you could certainly pay it up by age 65, kind of at the time of retirement. Has to be enforced for at least 15 years. So that again, that age 70 is kind of your top end for this product.
Okay.
At least for the lifetime, the income rider portion. Now, once you get that 60 plus, 65 plus, it gets pretty expensive from 65 to 70. So really, that's why I said the sweet spot's your 45 to 60, kind of your accumulation or late stage retirement planning.
Okay.
Now, one other place where this product kind of fits in nice is you've all heard of kind of wealth transfer strategy called, annuity maximization, or just people want to leave money to the kids or grandkids, right?
Mm-hmm.
What this product allows you to do is think about it this way. If you used your traditional guaranteed UL, no cash, no extra benefits, no bells or whistles, you're paying roughly, maybe a little bit less than this. Maybe it's $3,900 for the $500,000. But what happens is that unless death occurs, nothing gets paid out. So you're not going to get a long-term care type, event payout. And if you happen to run short of money and your whole wealth transfer plan kind of blows up on you, guess what? You're going to probably stop the premium, surrender the contract, and use that, annual premium for your own income purpose. So for a little bit more money, is it worth it to know that if you happen to need the money, you can actually get at it in a wealth transfer strategy as well for maybe your 60 to 65-year-olds? Second of all, the way I look at it, think about it. If you're leaving this to your kids or grandkids, and especially grandkids in a wealth transfer strategy, most time you have to die for that benefit to actually go to them. What happens at age 85? So death didn't occur, which is good. You didn't get sick, which is good. Now you're sitting out here with a $500,000 pool, and the intention was to gift that at some point at your death, right? Well, why not pull out the money as an income stream? Not that you need it, but you can actually gift that to them while you're still alive. to me, that's a very powerful thing for clients when they're looking at kind of a gifting wealth transfer strategy, is that they can actually take the money out, and maybe they take out the tax-free portion of their basis and pay for their grandkids' college. So they can actually see them using that for a good purpose, knowing that, again, the remaining is income tax-free at death. So you don't have to pull the whole thing out once you turn the income on. And you don't have to, by means, you don't have to do the whole thing. You can do part of that as well. So that's another very powerful sales, I think, tool when you're looking at wealth transfer. Now, again, the key is you want to pull it up by age 100. Due to that, the policy goes away at 100. So you maybe pull out your basis first, let it ride for 3 or 4 more years. And if you don't die, pull out the rest and just give it away, or use it for fun, whatever. So that's another, I think, neat little way to position the product. That's pretty much it. What I'm going to do is I'm going to send my... Go ahead.
We have a question. How difficult is the underwriting?
It's normal underwriting. Typically, the chronic riders are down through table C or table 3. You can have a heart attack in the past, maybe 5 years ago, some minor cancer issues in the past, as long as obviously it's not currently going on. It's no different than any other life policy. They still underwrite for it.
Perfect.
But again, you're not dealing with 75 to 85-year-olds, right?
Right.
You're dealing, like I said, the sweet spot's kind of your 40 to maybe 65 or 60. Okay. Normally, those people don't have a ton of health conditions at that point.
Exactly. Any other questions on this, guys? You did a good job.
Hey, Mike, I'm going to add one more thing. I'm going to send off to Jerry and you guys' team. I got a couple emails that with some of the microsite training links. American General has done a great job, and agent basically, or what do you want to call it, agent learning. There's tools, there's presentations, client videos you can send people via email. Just great training material, and there's a ton of stuff in there. It goes over the product, how to position it, et cetera. I'm going to forward you guys those links, and then just call your marketer at ECA.
Thanks, Shane. Appreciate it.
Cool. Okay, anything else?
Any questions, guys, before Jane leaves? Going once? Going twice? Really appreciate it, Shane. Great ideas.
Okay, take care, everybody. Bye.
Bye. So, Jeff, how would you see this fitting in with any of our software?
Well, I'm not sure that it fits in with the software. I think the thing I like about the products is the flexibility that you have. It's a way to draw income. It's a way to also add long-term care or kind of chronic illness protection. It's a way to leave a death benefit to your family if you die too soon. It's a way to draw income if you live a long time. In many ways, I think the way I look at it is kind of like longevity insurance on the back end of a plan to make sure that you can't outlive your income. It's kind of a win-win-win, like Shane explained. If you die early, your family gets a $500,000 death benefit. If you get sick, you can accelerate that death benefit for long-term care, and you don't have to take the money from your investments. If you don't need it, you're age 85, you can accelerate the death benefit and use it for your personal income, or like Shane talked about, gift it so that you can see the money that you were going to leave to your grandkids or your family. I do think there is something to the fact that you get to see them, use it, and enjoy it while you're still alive. We talk a lot about income and the need for income, and so when Shane talks about how would it work with some of our software, the software that we have is the sale plan. And I always encourage people to go out and look at the sale plan, because the sale plan is really a great way to draw income in retirement. But really what we recommend the sale plan for is people who are taking income now or are going to take income in the next 3 to 5 years. And the reason I say that is because the income riders on the annuities on the back end, they don't really work as well. You're starting to see more products that work well if you need income immediately, but a lot of them need time to build up and work. But if you have time and you don't need the income right away, and you can let those income riders build up and work, in some ways I think you might be better off looking at those rather than a sale. I always think it pays to kind of compare the two, but the sales sweet spot is really people who are taking income now or any time in the next 5 years. Because you can't accelerate the death benefit until you're age 85, typically we're going to be, and the issue age is up to 70, I think what you can do is kind of carve out some money on the back end from the market bucket or the annuity bucket and allocate it to this, because you are leveraging. You get $500,000 worth of benefit for $200,000. But certainly you can take a look at it. It's just that because the issue age is 70 and the income age is so high, 85, I'm not sure that it fits in a ladder. Most of the people we're going to see are going to be 65, 70, and we're going to take them out to age 75 or 80, so they won't be able to use it right away. But I still think it has merit in that it's kind of a nice, flexible win-win-win and a great way to leverage your assets. So,
well, do you guys get what Jeff's saying? It is a win-win-win, and that you're not. This is another way to get long-term care essentially for free, because the money's not going away. It's an asset. You're taking it from an asset in the market or an asset in their savings account and turning it into a different asset, which is going to work for either an income stream at age 85 or long-term care or death benefit. So they're not losing money with this. And it's protecting your asset manager. Like you were saying, it's protecting your assets. Because if somebody goes in a long-term care facility, they're just going to chew through their money really quick to be in a long-term care facility. Or even yes, go ahead, Jeff.
Yeah, and I think the thing that I really like about it is no matter how you look at this, you're making money. I mean, you're taking $200,000, and one way or the other, you're getting $500,000 out of it.
Mm-hmm.
So, with some of the long-term care and even MoneyGuard to a certain extent, you have a bigger pool of money, but that's not yours to keep. That's yours to use for long-term care as long as you need long-term care. With this, you have that pool of money to use as long-term care, but if you don't use it as long-term care, you're still going to get $500,000 worth of benefit, whether it's some combination of death benefit, living benefit, or long-term care. However you look at it, you're turning $200,000 into $500,000, and that's a pretty good deal.
That's a way good deal. And guys, what is the number? I've seen this over and over and over again. What percentage of let's see some answers in this. What percentage of clients are concerned about long-term care costs? High or low? Yeah, high. And when asked or interviewed, how many of them are saying their advisors are covering these costs with them? High or low? Low. And the reason being, and I get it, I get it, the reason being is that, first of all, we're asking them to spend money on something they might not get back. That's hard. It's hard to sell something and saying, hey, you know what, let's spend some money on this. We don't really plan on you needing it, but let's just spend some money on it anyways. I get that, but do you see how with this, when you present it to your clients, this is a way for us to diversify, because remember what he said, what did Shane say about correlation? Is this a high correlation or a low correlation product? Low. So it's a great way to diversify. Oh, what's going on? Somebody's blending something over there? Is that is that you, Missy, or you, Jeff?
Oh, that's not me.
No, it may have been Fred. Fred, did you just join us?
Yes.
Okay, I think it might have been Fred.
Oh, hey, can I add one more thing?
Yeah, please.
The other thing is, we don't, Shane talked about the wheelhouse of these products being kind of 40 to 65, and that might be just a little bit younger than what we traditionally run into. We're typically marketing to people kind of 60 and above, but you know what? I run into a lot of you guys that say, I'm meeting with these clients, I just did the 21, they love me, they want me to talk to their kids. And so increasingly you're going to see that you're going to be getting in front of these people more and more, and so this is a great thing. This is another great tool to have in your toolbox when you start meeting with these people that are a little bit younger, because I always get these questions, well, what do I do for them? And so this is a great thing to do for them.
Well, and a lot of us, our guys are RIAs who do have clients in that age group, but they have them in asset under management. This is a great way to protect your practice, guys. It's a fabulous way to protect your practice.
Yeah, because that's a great point. it's not just the client that takes the financial hit when they have a long-term care event. It's the RIA as well, because they have to spend down those assets.
Cool. So any questions to that? Otherwise, we have just one other topic we want to talk about. Super. Do you, but before we go to that other topic, do you guys like to see other ideas and products like this? Super. Good. Getting a lot of yeses. So I asked one of our guys to talk with us today, and the reason being is this: is when somebody comes on to the system, I ask them, how important is the 21? And what does everybody always tell me how important the 21 is? What do they say? Very important. Yeah, they get it because I hammer that at the training, right? And then they'll go through the big 3 training, and I want them to go actually do this with some of their clients, and guess what they tell me? At least half of the guys, guess what they tell me when I say, now go back and do these 21 with the clients. Guess what half the people say? Oh, no, Mike, I already have all their money. Well, guys, is that the purpose of the 21? Either we believe in it or we don't. If we believe in the 21, should we only do that thing we believe in for strange people, but not for the people that have already put their trust in us? Or should be with who? Everyone. And, you know, the thing, I'll ask people, say, oh, so you don't like your clients? No, I love my clients. Oh, I'm sorry. So you don't believe in the 21? No, I believe in the 21. Well, I'm getting confused here. You say that you already have your client's money, so why bother doing a 21? But then you're telling me, no, I believe in the 21, and because it's something everybody needs, and I love my clients, but I don't want to give the people I love the thing that they need. Does that make any sense to you guys? Now, let's take a step back, though. I can't tell you, I wish Jerry was on the phone call, too, but that's why we have Fred talking to us today. How many times I've been told in 15 years, Mike, I already have all this client's money. It's senseless to me to go back to see him. I already have all this client's money. I don't even know why I'm bothering doing 21. And invariably, guess what we find out? Guess what we find out? Yeah, exactly, Jim. More money. So, Fred, can you kind of share your experience with that with us?
Yes, I can. I apologize. My office has had major internet problems, so we're
No
all,
problem.
oh God, perfect timing on that. But no, I'll tell you what. I really wanted to get started on the seminars and do all of that, but I knew that October, November, December is kind of a tough time. So I made an excuse to go see clients. So I went and didn't do a real good job on the 21, which, by the way, Mike's right. I've got to start taping them, but I'm almost embarrassed to tape them because at times I'm not real good. But I want to do that. So I went and saw 3 different clients, went through the 21 Lite, if you will. So with the one client, he's going, well, you know, Fred, this sounds really great. I really need this, this, and this. And by the way, my mom has $600,000 over here that my sister and I are going to, when she passes away, it's ours. I want you to take a look at that. And by the way, I have $100,000 over in this account, which I never knew he had, and he's one of my best clients. And then he said, my sister could really use this. So he set me up with his sister. I went and saw her. Make a long story short, she has $1 million, and we just rolled $650,000 of that over. So my point is that I didn't want to just meet with them to kind of BS and catch up, but I had a reason to meet with them. And now they've got, you know, their durable power of attorney. We've got the medical power of attorney. He went and had one done on his mom. His sister has it done, and I'm going not this week, next week to see his mom about her $600,000.
So that's well over $1 million found money.
Yeah, and this is literally my single best client. He's referred me $2 million before this, but this time, you know, it's not. I take him to dinner or lunch, you know, and we just kind of talk. We have a great relationship. But now I had a reason to talk business, and he was thrilled with it. And actually, I have 3 appointments next week with my existing clients, and I'm telling you what, there's money there that I have no clue was there, and I was the one that knew I had all their money.
And did he say to you, why didn't you do this before, Fred? I mean, what's going on? I mean, why'd you wait till now to do this stuff? Did he get mad at you for doing it?
You know what? No, not at all. What he said was, he goes, "God, this is great, Fred. Why? This is awesome." And I kind of used one of Mike's lines that has said, "Hey, you know, I've had clients that have gone through what you wouldn't believe they've gone through, and you know, with the power of attorney and this, and I just want to make it my passion to make sure that you're completely covered." And he literally looked at me and said, "Thanks." Well, that was one. But here's the cool part: when I met his sister, and I went through everything with her, and then when I went back, I went and told her, I said, "Hey, by the way, I want to tell you right up front, the average account of mine's about $400,000, and you're killing it. You're so much above everybody else." Well, at the end of the hour-and-a-half meeting, she hugs me and says, "Thank you." I said, "What?" She goes, "Oh, I'm so much better than everybody else. When can you come back?"
So an excellent use of GOTS.
Yeah, she didn't listen to a damn thing I said except that. Oh, by the way, I didn't tell you this either. I might have. Like, I met with my other client, and first thing he said out of the gate when I started going through that, he goes, "Hold on a minute. I'm in this one group where they fly planes." And he goes, "I just met with a guy, and he said he's taking care of his aunt, but he's running into unbelievable things because," you ready for this, "the brokerage firm won't take his power of attorney." And I said, "Well, do you have one?" And he goes, "No." So we went through the whole thing. And by the way, that's the client that I thought most of the money, but he has another $500,000. So we're going back next week to meet with him.
They all have that money on the side. For some reason, even when they love us, even when they trust us, they just feel like having this extra money on the side just in case. I don't know why they do it, but they do. But when you do the 21, they're so enamored with all that you're doing, they say, "I don't even need to have it on the side. I'm just going to give it to you." And that happens over and over and over. And we just scratch our heads why guys drag their heels, don't want to do these on the, and you're not even doing the full one, are you? You're just doing the 21 light. I'm
probably doing the 4. I'm not real good yet on the 21. What I'm saying is,
can I add
21, I'm probably good at 4.
Yeah, Jeff.
Can I add something there? You know, we've had this statistic before, and I'll try and find it, but I read not very long ago that it's 70% of all advisors think they have all of their clients' money. And yet when you ask clients, only like 28% of clients say, "My advisor has all my money." So there's obviously this gap, this disconnect where we think they have all the money, but we obviously don't. Otherwise, we wouldn't have this gap. So I think it pays to go back, because Fred's story, like Mike was saying, isn't all that unusual. We hear that a lot. The other thing is, I heard a talk one time where a guy was saying, you know, if you're not as successful as you want to be, you need to just pick one of these things and work on it. And they were 5, they all started with the letter C. So you need to work on your confidence, you need to work on your competency, but one of them was contacts. He said, you know what, you might be 1 or 2 contacts away from just blowing the doors off whatever it is you want to do. And Fred's story about how, you know, I did this with my client and he gave me more money, but he introduced me to his mom and he introduced me to his sister, and I met this guy who, you know, is part of this investment group or this book club and he wants me to come speak. I hear that all the time. And going back, even if you didn't pick up any money, quite frankly, I've not heard a story. I've heard stories where they didn't always get money, but I've never heard a story where they either didn't get money or didn't get introduced to somebody. And those introductions are gold. And I would encourage you guys to go back to all of your clients, because even if it turns out that you do have all of your clients' money, which I kind of doubt, but even if it were true, they know other people that they can introduce you to. And this gives you an opportunity to talk about things that they haven't heard, things that are non-financial, that show you care, and they know somebody who needs that stuff.
And you know, Jeff, to reiterate one thing, I think what it allows, a lot of times clients are afraid to refer you because they're thinking, well, what if he doesn't do a nice job with the money? What if he doesn't make more money than his other advisor? But now they have a reason to refer you based nothing on the financial. Nothing. You're going to help them get into a better place. And if they're in a better place, then you will get the money. But they can refer you and feel a lot more comfortable referring you.
I think that's perfectly said.
And Fred, let me ask you a question. This is more of a touchy-feely. How does it make you feel as an advisor when you're going back and doing this with your clients? What if you got no money from the client? What if they just hugged you and said, "Thanks a lot for doing this"? How does it make you feel as an advisor? Does it make you feel any different? You're just like, "Oh, that's great." How do you feel?
Actually, I feel great because and I don't care who we are or what we do, we want to make a difference in people's lives. And when they hug you and tell you, "Hey, thanks for doing this," I feel like I'm making a difference. And if I make a difference for them, then they're going to remember that, and I'll be able to make a difference for the next person. And I don't care who you are, but if you start feeling that confidence, the old secret idea, then the money's going to flow. And it just makes me feel great.
Well, thank you for sharing that, Fred, because here's the thing you have to understand, guys. With this whole thing about the DOL rule, we don't know how that's going to pan out, but however it pans out, there could be, highly likely, that we'll have to do more disclosing of getting paid commissions, of doing whatever. Guess what? We have no problem doing that. Why would we not have any problem disclosing the fact that we get paid commission? Because we're not just doing what? What, Fred? I'm sorry, Fred, go ahead.
I'm saying because we definitely earn it.
Yes.
I mean, they're going to pay you. I mean, if you find a nice car and it's worthwhile, you're going to pay for it.
Is a Cadillac the same price as a Chevy?
Correct.
And so we're not afraid of that. And we actually used to use a script with this all the time for letting people know what the commission was, and we give them the option. Pay us commission, pay us a fee. Which one do you want? And they'd always choose the commission. So I have no problem with having to disclose. Because when the way we do things, they're saying, yeah, I want all this stuff, and I'll pay for it. But if all we're doing is selling investments, man, you're going to find a lot of people being run out of this industry. If all they're doing is selling investments and they have to start talking about commission, that won't affect us at all. Same thing with the robo-advisors. We don't have to worry about them because what are the robo-advisors? And now the robo-advisors have learned that, hey, we can't just be robo-advisors because we can't gather enough assets. We need to have some human touch on the other side. So all they're doing is becoming a TD Ameritrade because the robo-advisors now have numbers that you can call. You can talk to a real human being, but what are they always talking about? What are they talking about 100% of the time? Money, investments. And guess what they're not doing? All the stuff that we do. So I keep telling you guys, you are the good guys. You are the guys in the white hats. And I'm glad, Fred, that it does make you feel that way because it should, because you're doing things the right way. And you are, we're talking about not the top 1%. We're talking about the top 1% of 1% because I've been doing this for 15 years, and Jeff, you have too. How many times have our guys run across anybody doing what we do, even close to what we do?
No, I don't. I've never heard of anybody running across anybody that does anything like these things.
So we're in the top 1% of 1%. So,
by the way,
yeah, go ahead.
Oh, I'm sorry. Just one thing to what you're talking about is when I went and saw my Keith, I saw him back in June before I met you. Saw him in June, and I was going over this new Wealth Max Plus, and and his exact words where he goes, "Oh man, I feel like I'm being sold something." And I'm going, "No, I just want you to take a look at it." Well, he just put $30,000 into it after this meeting that we had.
That's great.
Not a lot, but it's still 30 that I didn't have. Well, actually 30 that I didn't know he had. But anyhow, yeah. And I felt like, I'm trying to sell him a used car because I need the commission this month.
Mm-hmm. And even our best clients can feel that about us if we're not providing value. And Fred, now every time we go back and see our clients for an annual review, what's the first thing we whip out?
I just go back through his whole durable power, go through the whole thing, and at the end, we'll talk about the investments.
That's right, because we're constantly reminding them we're not just your investment guy. We are a true advisor to you. And yeah, it might only take 10 minutes to say, now, has anything changed when it comes to your power of attorney? Anything happening health-wise? Anything happening with your agents there? So, but just by doing that, even though it's a 30-second conversation, it constantly reinforces that we are more than just their investment guy. Because if you're just an investment guy, you're only an investment guy until what? Let's see some answers to this. You're only their investment guy until what? If all you are is your investment guy, you're only their investment guy until what? They find a what? Someone prettier, right, Todd? Someone with a better investment. And there's always going to be someone going to show them a better investment because the people present these things. When advisors are showing them things, are they showing them things in a well-balanced way, or are they showing them only the good stuff? And so, we're going to get replaced if we're not things other than just their investment guy. Super. So, Fred, thank you so much for sharing that. And
sorry I was late getting on there. We're good.
No, worked out good. Worked out good. Jeff, anything? So thanks a lot, Fred. And any other? Jeff, do you want to add anything?
No, I would just encourage you guys. Really, Mike talked at the beginning about how there's kind of this disconnect that we really believe in the 21 and we really love our clients, but we don't want to take the 21 back to our clients because we're fill in the blank. You need to go back and do this. I mean, this is not an uncommon story, and it can be your story too if you just go out and do this.
And it's the right thing to do, guys. So you're coming into a dormant month here with December. Now's the time to be doing that. Thanks again, Fred, and Jane's not, and you betcha. And I want to appreciate
Thanksgiving, everybody. Appreciate it.
Yeah, thanks, Fred. So, and again, thanks to Shane at ECA for presenting that idea. So, guys, I really appreciate you guys. It is Thanksgiving. I want to thank you all for this past year. It's been a wonderful year. And, again, we're taking Friday off. We'll be back on Monday. And I hope you, again, you and your families have a healthy and happy Thanksgiving. Thanks, everybody.